So we're estimating ending inventory, and we've talked about the gross profit method. The retail method, another way to estimate ending inventory. This one's a little bit different than the gross profit method, in that this method is actually okay for financial statements and for the IRS. They both accept this as a reasonable way to estimate your ending inventory. It's based on the relationship between cost and selling price, but with the retail inventory method, you're using the current cost to retail percentage as opposed to the gross profit percentage, which is most likely historical. Okay, so it's a little more accurate, and it is allowed for financial reporting and by the IRS. Okay, so how does this work? Let's take a look at this. This is at a very basic level, how it works. You start with your goods available for sale at retail prices. Okay, so you just picture that. You've got all your goods available for sale. You have your beginning inventory plus your purchases. You know what you've bought. You know what you're going to sell it for. So you have your goods available at retail prices. And then, at the end of the period, you subtract your sales, your actual sales, and of course at retail prices. So now you've got your ending inventory at retail prices. You had your goods available, you took away what you sold, this is what you got left at retail. So now you calculate your cost to retail percentage, which is going to be your ending inventory at retail. You're going to multiply that times the cost to retail percentage. Now how do you get that? You can take your goods available for sale at cost, divided by your goods available for sale at retail. That gives you the percentage. When you multiply those out, you get your ending inventory at cost. Now that seems like it's fairly straightforward, and on a very basic level it is, but it obviously gets much more complicated because retail method can be modified to approximate FIFO, LIFO, or average cost. Okay, so let's take a look at some of the complications here. Okay, so let's look at an example of your basic retail method. This is what you would be given. Okay, you'd be given your cost, you'd be given your retail. So you get your beginning inventory at both cost and retail, what you bought at cost and retail, and your available. Okay, your cost to retail percentage, you take the cost divided by the retail, and you get your percentage. Now you deduct your sales. Say you had 400,000 in sales. That means you've got 160 of ending inventory at retail. Multiply times the 62%, and this is your ending inventory at cost. Okay? So if you want to think a little bit about what's going on here, this is how we usually calculate things. We go beginning plus purchases, goods available, less ending gives you cost of goods sold. But we're just sort of reversing that here. Goods available less your cost of goods sold can also give you your ending inventory. Okay, so that's real basic. Now for the not so basic part, you have markups and markdowns that we have to get to. Okay, so you have your initial markup, and if you think about stores you've gone to, nothing's just got one price tag on it. It's been marked up, it's been marked down, and all of that. So we have the initial markup, original amount of markup from cost to selling price. That's your original markup. Then you have additional markups. They say, oh, this is selling well, we'll up the price. Then you can have a markup cancellation. You eliminate that additional markup. Then you can have markdowns, reductions below the original selling price. And then you can cancel those and have markdown cancellations. So if you want to look at it with markups and markdowns, you think you've got the original cost as your initial markup as your selling price. You could have an additional markup of 2, now it's 12, and then you could have a markup cancellation and get it down to 10.50. And here, if you've got your original cost, you get your initial markup, but then you have a markdown, and then you can have a markdown cancellation. So these do complicate things a little bit. Okay, so if you want to look at exercise 920, that will show you pretty much how they work. Okay, so when we're working with markups and markdowns, we're going to be adding markups and subtracting markup cancellations, and we're going to be deducting markdowns and adding markdown cancellations. Okay, So next we'll go on to how the different cost flow assumptions can be approximated using this method.